Hey everyone, Brian Bogner and Greg Towner here. It is time for our January monthly update on the markets. Of course, there's been a lot going on. December was a really tough year in the markets. Then we got Christmas Eve, Santa came to town. We hit a low and we've been rallying good. So we got a lot to talk about. So let's go ahead and get started. Greg, you want to take it away here?
Yeah, absolutely. Do we think the correction's over? That's certainly a question we've been getting from a handful of people. There's a couple of ways that we look at this, Brian. This is actually a repeat of the chart we looked at last month, but we're only about halfway through what ended up being the correction last time. And we talked about a couple things. We said as far as the distance and how far it could go down, historically over the last couple of corrections, we came down to about that blue line, the 200-week moving average. Doesn't always have to work that way, but it just so happens this time it stopped right exactly at that line, at least so far. So far so good there. But the other thing that we talked about was the length of time some of these corrections can take. Historically, 6 months, 9 months, somewhere in that ballpark. So certainly we're not there yet as far as time. We could have a lot more back and forth and choppiness, even back down to those lows perhaps. There's no way to know for sure. But we still think there's a little more back and forth that needs to occur before you can really move out to higher highs.
Well, I think, we say this word a lot, mean reversion, right? Reverting when price reverts to a mean. And so a mean is simply a moving average. In this case, right, you got a 200-day moving average. And, what happens is when it gets extended, right, from that mean, you see it revert back down to these longer term trends. I think another good thing is the trend is still up, right? I mean, the 200-day is still moving higher. 2015 and 16 was a kind of a period where everything just kind of went sideways. And again, this corrected, I think, like you say, more in time. And this got very extended, came back to it, it's come off to it. But yes, I would agree that, we could probably see a little more here as it continues this process.
Yeah.
Yeah. All right. What do we got here?
Well, one thing that we've shown a few different ways is talking about how volatility changed last year. Go back a couple of years, there was almost no volatility. So last year felt like extraordinary volatility to a lot of investors. The reality is if we look at the range between the high in the year and the low within the year, we weren't even quite back to the long-term average. And certainly plenty of years, there was much more volatility. So it felt like a lot, I think, because it came all at once there at the end of the year and because we hadn't seen much of it in the prior few years. But the reality is last year was nothing out of the norm, and it should be expected when you're investing longer-term assets.
Right. All right, Greg, let me put my nerd hat on here and ask you, how important is the Fed's balance sheet? What? The Fed, the balance sheet? Now, how important is this to everything that we're talking about right now?
Yeah, Brian, we wouldn't go this deep in the weeds if it wasn't really important. So bear with me for a second here. So when we're talking about the Fed's balance sheets, we're talking about the global central bank balance sheets throughout the world. The nice colors at the top is the size of the assets that all these global central banks have. This is back from the beginning of the financial crisis. So we can see for the most part it's been going up all along, and now lately it's more flat. But if we go down to the very bottom of the screen, this is the rate of change year over year. For the first time now since the financial crisis, it's actually in a negative. Global central banks are actually tightening a little bit. I think you hear a lot about trade talk and all of that, and that's certainly very important. But I think really one of the bigger reasons that the market had its big sell-off was the fear that global central banks are starting to tighten. The old saying, don't fight the Fed. And I think people started to get a little afraid of that. And then, not coincidentally, the market rallied back around the time that the Fed started to say, hey, maybe we won't raise rates quite so much next year. Maybe we'll be a little bit more open-minded about how we do our, rolling off our assets. So this is a big thing to watch, not just in the weeks ahead, but literally in the years ahead. What global central banks do, how fast do they tighten? So this is something that's really affecting markets now, but we think can for quite a while.
Yeah, I mean, basically, we've had this huge tailwind of this expansionary, this is money, right? This is money in the system. And basically, this is, we went from globally, really we've doubled in size globally, I guess more than anything over that period of time. So the good news is there's still all that liquidity out there. But yeah, as it starts to contract, what, if, how, when, that will happen. Just something we're definitely watching here as well. How's the economy handling all this volatility we're dealing with?
Yeah, you can dig down and find a lot of things about the economy that show that it's weakening or show some concerns, and that's understandable. But when we look at one of the most important things, certainly you could argue the most important thing, the jobs number, the last jobs number that came out blew away expectations, almost double expectations, the highest jobs number we saw since February last year. It really surprised people, that helped the market. So I think the economy is still good. It'll probably be slower this year. Last year we had the boost from the tax cut, but I think all in all it's still going to be fairly solid, but there are still some things we're going to keep an eye on.
Now I know this is anecdotal, but just some of the traveling that I did a little bit around the holidays, and I had to go to Florida for a little bit, and was in Georgia some, but the restaurants, the place, everything is packed out. People are spending money. I'm seeing it. I'm seeing it right now, and it's got to be a reflection that people are working, making money, and ultimately that's good for the economy.
Yeah, I agree. I think the consumer is doing really well. Where you start to see some of the hints is more in the manufacturing side. The companies are not sure what to make of interest rate changes, the trade war. They're kind of sitting back a little bit. They're seeing slowness in other parts of the world. So yeah, the consumer is doing great, largely because of this jobs number. Some of the minor cracks that we're seeing are other areas of the market so far.
Got it. All right. So we're in a correction, could still need a little more time. We're going to watch this central bank balance sheet, liquidity. It's a key factor to monitor. Don't worry. We got our eyes on it. If this puts you to sleep, we're up awake at night tracking this. And yes, the economy has been slowing some, but we are a consumer-driven economy here, and if people are working, that's usually going to bode well for things. So if you've got any questions, give us a call, shoot us an email. Happy New Year to you, and have a great day.